So, with that, now to take you down to the real ground level on these various core pillars of our business. Time for Fabien Klecha, our Chief Investment Officer since 12 years, talk about investment management.
I wanted to give you a break from the numbers, show you our team, and with this picture, explain a little bit of our philosophy when it comes to underwriting and investment. As Harry just said, I've been 13 years in Hoist, and I've been in various positions. I've been the country manager in France. I've been the country manager for Italy in interim. I've been originating loans, sourcing loans, loan portfolios across Europe as well. And 3 years ago, I took over the investment team. And the investment team has a particularity, our investment team has a particularity, is that, as you can see, it's very diverse. They are very talented people, but you have talented people throughout the industry. The particularity is that they are reporting centrally, but they are sitting locally. So most of our team members, they sit next to the operations. And it is a key to our success, because if you want to make sure you capture the know-how of our local team into our valuation, that you have a good understanding of the risk, you cannot see that just with data. You need to make sense of data. You need to make sense of the due diligence that we do, and you need to connect that with your valuation model. You need to connect that with your SPA and the reps and warranties that comes with it. So that's a key part of what we do. So with that, so as you can see on the right-hand side, the team is spread out across Europe, sitting next to the markets, and that is essential to what we do. We're now, as at end of Q2, close to 27 billion SEK in book value, coming from 18 billion a few years back. We've grown the book in just 3 years by almost 50%. And in terms of ERC, what that means, because obviously our old portfolio amortized, it means that half of the ERC has been acquired since 2022. This year, we have already acquired 4.3 billion. And just to give you an idea of the live deals, and I'm talking about the live deals, meaning that those 43 people that you see here, they are looking at a pipeline of 20 billion SEK as we speak. So preparing analysis, submitting non-binding offers, binding offers, negotiating SPAs, or waiting the answer from the seller. This is what we are talking about here. And one thing I think we achieved together as a group, together with the country managers, is to both increase our margin, and I'll come to it afterwards, but at the same time increasing significantly our performance. So the performance of the vintages acquired since 2022, so since we started this journey essentially toward the 36 billion target, is 116%. And that compares to the 108% that we have for the whole book. So we see it as a combo of more volume, more margin, more performance. And this is, this strategy that Lars and Harry talked about, we are, proving in a way it works in practice and with numbers. Now, throughout this presentation, I try to explain what we do in the investment function. Well, in the investment function, we are involved in pretty much all aspects of the life cycle of a portfolio. That is, from the sourcing, we are in contact with all of the major European banks that we tier 1, tier 2, tier 3, and we are in regular contact with them, obviously, and that's what we call the primary market. So this is what Harry talked about, this NPL stock being 400 billion. And we also are in contact with industry peers and funds. And this is around 600 billion. So this is very significant too. And just to give you a number on that, 25% of the acquisitions we've done this year actually are coming from the secondary market. So us buying from funds or from peers. That's the sourcing part. Then we underwrite portfolios. And here, I think the key thing is that we are data-driven. What does it mean? It means that we never agree to put any unsubstantiated, I will go there, uplift on the curve. We are data-driven. The curve comes from data, full stop. And if we expect a performance increase due to operational aspect, we need to do a mock-up before, we need to do a test before we accept to deploy significant amount of money into, we don't take bets. Let's make it simple. On top of that, we have a very strong governance. I'll come to that after. And that is really helping making sure we get the learning out of our investment. We have a central database, a central data lake that captures all aspects of our underwriting. That is collection performance, operational KPIs, costs, real estate value, and more, that allow us to deep dive into the portfolio on a very short notice. So we are in constant collaboration with our finance team, business control, but also the local countries to discuss about our finding and give insights and constantly learn from what we do. We've introduced the concept of feedback loop, meaning that 6 to 9 months after the onboarding of a portfolio, we re-underwrite the portfolio to make sure that we verify the assumptions we have taken are correct, and that we learn from our investment on a constant basis. So the CEO, the CFO, myself, the CEO, we're in a committee and we are looking at what we approved 6 months, 9 months before. And that's quite fundamental. Finally, revaluations. Revaluations are independently driven with Christian, our CFO, but we provide analysis, of course, but this is independent from the investment function. And last but not least, portfolio divestment. As it was said, I mean, you've seen we've sold the UK a couple of years ago, but we're also selling segments of our portfolio to specialized players. We like to say better owners, people who see more value, or for strategic reasons. So this is what we do at Hoist. In terms of our strategy, we focus on banking claims. This is what we buy. We buy banking claims. We don't buy telcos, we don't buy utilities. This is not our core business. 99% of what we have is banking claims. So what is it in practice? So it's consumer loans, whether it's unsecured or secured. Secured are typically mortgages, so backed with real estate collaterals, and SMEs. SMEs can be unsecured or secured. But most of the time, or every time, sorry, they are granular. Our largest single exposure at Hoist is 0.08% of our book value. Our top 100 exposures are 1.96% of our book. This gives you an idea of the granularity of our book. So we have pretty predictable performance as a consequence of that. We are dedicated to a number of markets. Those markets are listed here. You know them: Italy, Germany, UK, Poland, Greece, Sweden, Spain, France, Netherlands, Belgium. Why is that? Well, those markets, they make the majority of the NPL stock anyways. They have a strong legal system that we can rely on. And we have a strong competitive position in those countries. So that is what we buy. Now, on top of that, we are very proactive in the management of our portfolios. So we are constantly, centrally monitoring the portfolios, monitoring the performance metrics. We are benchmarking our portfolios, and we don't just look at the numbers, we also monitor the SPA reps and warranties to make sure that what has been sold to us and what is repped in the SPA is actually the reality, and if not, we get indemnification. And that is a large part of making sound investments, because if you buy a portfolio and you have the wrong value of claims, or if you have claims which are supposed to be titled who are not titled, or you're supposed to have a collateral and you don't have a collateral, then you end up in trouble. And finally, just to get into a little bit more details on what we do on proactive sourcing, yes, well, we problem solve for banks. Problem solve for banks, I mean, as was said, we have the same regulation. We've been through the same issues. We know about the regulation as well as them. The only little difference is that 100% of our book is NPLs. So we know how to structure efficiently the deconsolidation of those NPLs, whilst either retaining exposure to it or completely removed from balance sheet. Second point important, co-investment. As a lot of players in the industry are moving from a balance sheet business to an asset-light business, there is opportunity for us to co-invest. And there's opportunity for us to co-invest whilst retaining our cost base low, and whilst making them happy because we give them volume of servicing. And this is exactly what we do. And this is actually an important point in our growth this year and for the coming years as well. And finally, secondary market opportunities could be industry peers, could be funds. We work a lot with funds. As you know, funds, they have 5-6 years time horizons. At some point they sell, we buy. So that is on our strategy. Our book. So back in 2018, we expanded into secured assets. Now it represents 28% of our book, but it represents half of our investment this year. So it's mainly residential real estate backed portfolios, whether it's mortgages or SME, it's real estate backed, residential real estate backed. And we see the SME segment actually as being core to our growth because we see the level of NPLs for this particular asset class going up significantly. In terms of book value per market, you see there's no predominating market. We are super well diversified. And actually, this makes our book very resilient to operational risk, market risk. It is really comfortable to be able to deploy money where it best suits us. Because the team you've seen a couple of slides before, they are not dedicated to one single market. They cover typically 2 or 3 markets each. So we can allocate resources on the markets that need the most resources at a certain point in time. And the last point, it was discussed with Harry, is the portion of what we managed operationally, internally or externally. Well, this portion has increased significantly, went from 6 to 38% the last few years. And this gives a very big operating leverage. What does it mean? It means that we don't need to build a fixed cost base. We don't need to feed the machine, as some people say in the industry. So even if we are in a context where the book value decreases, we can still deliver the ROE to our investors. And this is the idea behind it. There's a lot of spare capacity in the industry. Let's use it. Let's work with our peers. Let's partner with our peers rather than compete with everyone. Here, I'm going to get a little bit more detailed. It's just for people who know a little bit less about our industry. So typically, we source a lot of portfolios. And out of those portfolios, there are some that are fitting our strategy, some who are not fitting our strategy. Typically, if someone comes with a portfolio of single names with lines at 100 million exposure, we don't like strategy filter. We rule it out. We focus on the granular banking portfolios. Then we start an initial analysis, just portfolio description, just to understand what we're talking about. We start the pricing. We submit a non-binding bid. The seller tells us, you're within what our expectation or not. If so, we go to the investment committee. We submit a binding offer. We start the SPA negotiation based on the due diligence finding, based on the approval from the investment committee, and that's particularly important. And finally, we sign and close. In terms of governance, I think a key aspect is the collaboration between the country management teams and the investment team. We jointly underwrite the portfolio. So our team is taking charge of the modeling of the due diligence strategy. The local team, the operational team, and the management team is taking charge of the due diligence work, the cost aspects, and feeding in their know-how into the valuation. That is selecting the comparable data we're going to use. So there's a discussion, a healthy discussion. When we agree, we go to the committee. This committee, investment committee, is shared by myself, but actually there's Harry, our CFO, Christian, our CFO, Misha, our CEO, are present, and the country manager has a vote too for the deal. So it's not that we can invest in the country without the approval of the country manager. And then we go up to board, investment committee, and full board, depending on the size of the transactions. And there's been some complaint this year that we had a little bit too many board investment committees. That's just because we had a lot of large transactions to look at. In terms of monitoring, we have monitoring within the team. So I talked about the IC feedback loop, but we also have independent quality review. That means that there's a peer in the team that underwrites separately to challenge and gives his own opinion about the transaction. And we track the performance of the portfolio depending on who has underwritten the portfolio. And on top of that, we have the reevaluation committee that is independent. We have the risk function that participates to the investment committees and gives a review as well. And then, of course, internal audit, external audit contributing. So at Hoist, now talking about how we look at the returns on our portfolio. Well, we are, in a way, like any investor looking at the net money multiple, that is the net cash divided by the price, the weighted average life, which is when the maturity of the cash flows, or the IR, which is an indication of the time value of money. But the most important KPI to us is really the return on equity. The return on equity captures the leverage level, capture the cost of debt, capture the times value of money, captures everything, and is completely in line with our group target anyways. So going down to earth now, looking at an illustrative, I insist, investment case. So here it's a mortgage NPL book in a country. So typically we look at IR, we look at net money multiple, we look at return on equity, okay? And this is our base case here. So what do? We stress our assumptions. So for example, we are buying this mortgage book, so it's residential real estate. What if real estate price goes down 20%. Well, then our returns become 10.7 IR and 45% return on equity with a 1.45 money multiple. What if the assets are more illiquid than we thought, or if we have trouble selling or repossessing? And on average, the WAL goes from 40 to 52 months. Well, this is what happens to our IR and ROC. So this is 2 examples of sensitivities we do. But in reality, we also take into consideration other aspects. The concentration of ERC, so what of our expectation within the portfolio, the asset liquidity. We typically have a scoring to assign liquidity measures for the type of assets. Obviously, our due diligence finding, they are fed into the model, but they also are fed into the sale purchase agreement contract, and our experience with this asset class. We have a centrally data-driven approach. So what does it mean? We have a data lake. All the data we have in the country, we have centrally, and we have access to them in an efficient and cost-effective way. We have databases structured in different ways, but essentially we have access to all type of data: collection data, operational data, costs, pricing assumptions. So how we segmented the portfolio at pricing is also stored so that we can challenge our pricing methodology. That's the particularly used in the IC feedback loop. Collateral as well. I mean, if there's a fire in a region, we know which region, we know how we are impacted, or flood, or things like that. And we have also a centralized automated reporting. And that gives us the ability to manage very large data sets very efficiently. We use, for example, tools like Alteryx. This is what we use for pricing. We don't use Excel. So we have it's a combination of an ETL and an analytics model that allows us to have an audit trail on our evaluation and to make millions of sensitivities in a very easy way, in a very efficient way. Now, going to what happened the past, let's say, 3 years. Well, we increased the book since 2022, 50%, 64% if you look backwards towards the COVID time. But at the same time, we increased our margin, that is our IR, that we are not disclosing here, but just putting as an index, by 55% on average. So you look at a company that is growing, 50% in a couple of years, and is also growing its margin by 50%, and is also increasing its performance significantly. So that's the short version of that. Now, in terms of the market outlook, getting a little bit into more details here, but I'm trying to make it easy to understand. We are on average investing 0.5% of the stock on a yearly basis. So there is abundant investable market for us. 2/3 of the NPL stock is our addressable market plus the secondary market. So in total, we have the 400 billion. We have the stock of stage 2 loans, which are not NPL yet, but part of it will be. That is piling up to 1.9 trillion now. And then we have 600 billion on the secondary market as well. So there's abundant offer of NPLs in the market that we can take advantage of. And that is in a context where the rates went up, where our funding stays stable, and where the secondary market is a key focus of the regulator. Christian will come to it, but with a special status for people like us. So in a summary, we have capacity to source transactions. We have capacity to underwrite and data to underwrite. We have a clear regulatory status. We have a strong track record. We are well capitalized. So we are in a good place to be a leading player in the industry for the coming years, I believe. So that was the asset side of things. If you remember the balance sheet that Lars shown, and now we're going to go with Christian on the liability side of things.